So why don't you tell me a little bit about what inflation is in layman's terms, something that we can all understand. What is it?
So just generally speaking, inflation is a general rise in prices over time. That's all that it really is. It's related to GDP or your gross domestic product, but really it's just things cost more now than they used to. Speaking very generally, that's what inflation means. And that of course covers the whole gamut of what we consider goods and services in the country. Inflation, the way it's put out there in the news, they say it's a bad thing, but it's actually not. Inflation is something that you naturally want to have in a advanced economy like what we have in the United States. So for an economy like ours, you want inflation to be controlled and steady and predictable. The reason why we're talking about it now is that inflation has not been that lately.
Welcome back to the Money and More podcast. My name is Madison Foster.
And I am Ryan Bowling. Thank you again for joining us and listening, where we hope to make sense of your money.
Ryan, welcome. Today we have a topic that is very timely, very hot button, something everyone loves to talk about, inflation.
Yes, absolutely. And it can be a little bit difficult to talk about because nobody, it seems, has a really clear understanding of what inflation is. So we're going to try to demystify it a little bit, make some sense of it, because you read all these headlines about it, especially, in today's, we hear a lot about it in political news. Inflation is just everywhere. So we'll spend a little bit talking about what it is and how you can protect your assets from it.
Okay, so like you mentioned, inflation is everywhere, but a lot of us don't exactly know what that is. So why don't you tell me a little bit about what inflation is in layman's terms, something that we can all understand. What is it?
Yeah, so just generally speaking, inflation is a general rise in prices over time. So that's all that it really is. It's related to GDP or your gross domestic product, but really it's just things cost more now than they used to. So speaking very generally, that's what inflation means. And that, of course, covers the whole gamut of what we consider goods and services in the country. But really, it's about eggs years ago costing $1.50. Now they cost $3. Or obviously, I'm of a generation where I can even remember that gas prices when they were $1 a gallon, and that's not the case anymore. They're obviously consistently $3 and higher. But inflation, it's just, things cost more than they used to.
Got it. $1 a gallon sounds great, honestly. But basically, so what you're telling us is when our grandparents are complaining that back in my day, this used to cost a nickel, we can thank inflation for that.
Yeah. And so generally speaking, inflation, the way it's put out there in the news, they say it's a bad thing, but it's actually not. Inflation is something that you naturally want to have in a advanced economy like what we have in the United States. So the Federal Reserve Bank, sometimes you hear them called the Fed, they want to keep inflation at a consistent roundabout 2% growth. So for an economy like ours, you want to see a little bit, but that's sort of the key. You want inflation to be controlled and steady and predictable. And the reason why we're talking about it now is that inflation has not been that lately. So coming through the pandemic, obviously you had really quick inflation to a point the Fed couldn't control it with the economic levers that they have at their disposal, which usually to people like us in banking comes in terms of what interest rates look like. So they had to make a lot of interest rate increases over a short period of time, but slow, controlled inflation is actually a good thing for an economy. That's what you want to see. They keep it around 2% is always their goal mark, so that, for instance, the general person getting a 3% pay raise every year, they can keep up with that sort of inflation. But when it jumps up and we saw inflation at like 8, 10, 12%, that's when it gets scary and it gets out of control. And the Fed can't keep up with that. So inflation in itself, not necessarily a bad thing.
Got it. Well, that's good information to have. Like you said, I think there's definitely a very negative connotation when people hear that inflation is happening or that it's an issue. So it obviously has implications that are very far reaching. So why don't you tell us a little bit about how it impacts the economy as a whole when we are going through a period of inflation?
Yeah. So inflation can, in essence, decrease your purchasing power. So, say you have a set fixed income and you wanted to obviously fill up your tank of gas. So, the amount of money you had didn't change, but the amount that your gas cost, it did change. It went higher. So, now you've got less money to spend on other things to help drive the economy. So, it decreases your purchasing power overall, and you put that on a huge national scale, and that tips a lot of balances in either direction. So a lot of people, they consider inflation to be sort of this silent tax because you don't really feel it. You don't really know that it's there when you see the cost of things at the grocery store, or say you want to buy video games and their prices went up. You don't naturally see those things all the time because they're built into the prices that companies put out there. So inflation can be called a silent tax because of that, but really it's just your purchasing power is shifting as these prices go up.
So is inflation something that you feel consumers should pay attention to? Is it risky to ignore? Do you recommend to just kind of ignore it since it's a normal part of the like where do we fall on should we pay attention? Should we care? Should we not?
Wow, that's an excellent question. It's one of those things, sort of like checking your 401k. If you do it every day, you're going to get probably nothing but bad news. But over long periods of time, yeah, it's worth paying attention to. So if you're checking out inflation, seeing what it's doing as the Federal Reserve Bank maybe changes their policy when they meet every couple of months, that's probably a good time to check in and see how it's doing so that you can apply it to maybe your CDs, or you've got maybe money in a high yield savings account, seeing what that rate looks like. You can check in on that stuff, I think, periodically, but to do it every day, it's probably not in your best interest.
Got it. So what I'm hearing is not so much that we're getting depressed, but enough that we are being well informed as to our economic state. Is that what I'm
Yes,
saying? Okay, great.
I think you were picking that up.
Okay. Well, of course, you did write a great blog article on our Money and More blog that we have about this topic specifically. And you mentioned three different strategies on how to best protect your assets against inflation. The first one that you mentioned is diversifying your portfolio. Diversification, of course, buzzword in finance. Tell me a little bit more about what that means and how that's going to help.
Yeah. So the first thing I'll say is, of course, we are not investment or tax professionals, so please don't take advice from us on what you should do with your investments. But that being said, yeah, diversity is key to writing out anything that changes over time. So don't put all of your assets into one single basket, especially they say that a lot if you're invested in the stock market. So if you're buying individual stocks, definitely diversify what that looks like. Um, Keep some real estate if you can. Obviously, you've got money in equity, probably invested in any home or land purchase that you have, and those things. Generally speaking, of course, there are bumps along the way, but generally, real estate, a solid investment over time. It's going to appreciate in value. So one of the best things you can do with that, but also keeping cash on hand. And by cash, we mean things like putting your money in the bank into something that earns you a significant interest rate. So keeping some money in a checking account that earns interest is a good idea for your primary spending, things that you're paying your bills out of. But also look at CD rates now, still fantastic. So highly recommend putting money into a high interest CD, especially a CD laddering. So we've got a couple of blog articles about what a CD laddering strategy can look like for you, but basically that allows you to stagger your maturity dates on your CDs so that you keep them fairly liquid. You've got access to them. There are also products out there like no penalty CDs you can look into where you can get your money out of them without a penalty one time, or a bump up if you feel like rates may go up at some point. You could check out a bump up CD, get a higher interest rate going without needing to redo all of the paperwork for a CD. And then also look at high yield savings accounts. So those accounts will pay out interest. Some of them do monthly, some of them do quarterly or semi-annually. At OMB, our savings accounts pay their interest out every 3 months. So that's basically like keeping in a very liquid 3-month CD. So you're constantly seeing interest come in those accounts. So obviously putting cash into a high yield, either CD or savings, is going to help ride out some of those bumps in the market that you may see when you have inflation that is going really rapidly. And so that's one way you can definitely protect yourself against the rising tide of inflation, is to earn more interest on the cash that you're keeping.
Awesome. I am such a big fan of high yield savings accounts. I love just sticking my savings in there and watching it earn money on money on money all the time. It's great. I feel like compound interest is a real life hack.
It absolutely is. So obviously the way in banking it works, banks take your deposits, then they loan out that money at a higher interest rate than what they're paying you. So banks encourage you to put money in there so that they can then work the margin. So it becomes a winning situation for you when you can take advantage of a high yield account, because the bank will then turn around, make a loan on it, and earn money off of that margin. So taking advantage of high interest rates for CDs and savings accounts and even money markets, absolutely the way to go.
Absolutely. So bringing it back here, if you had to describe just kind of in like a sentence or two, why is diversification so important, especially as it pertains to protecting yourself and your assets against inflation and other economic conditions?
It is important because you want to avoid risk. So putting all of your eggs, so to speak, in one single basket opens yourself up to risk. And diversification in your portfolio, in the way you're handling your assets, helps alleviate the risk in doing it.
Got it. Okay, so going into your second strategy here, reevaluating fixed income investments. Tell us a little bit about that.
Yeah, so obviously, when you have fixed rates, so say you have locked in your money in a CD over, I don't know, 3 years, you're not able to then access that money and negotiate higher rates should the market change. So if you've got money at 2% and it's there for 3 years, then that's what you're stuck with, and inflation may have surpassed it by that point in time. So reevaluating that, especially when it comes to the bond market, if that's something you are invested in, inflation can eat away at those fixed rate of return that you have. So it's important periodically to reevaluate where you have those fixed rates so that you can combat the changes in inflation that occur.
Okay. So in situations like that, sometimes it is better to do some sort of security that's a shorter term, that's a shorter duration. Would you recommend that at times like that?
Yeah, or you can hedge your bets on doing like a CD ladder will help you do that. So yeah, you can have some. Say you were able to find a CD that's paying you 3% over 3 or 4 years. Well, also don't put all of your money into that. Take something for 7 months that's at 4.5 or 5%, so that you can access that stuff faster, and then you can start to roll it over into other things. But I think hedge your bets sort of in a way, with some shorter terms and some longer terms, so that you can think of the bigger picture overall and what your strategy in combating inflation looks like.
Sure. And I think just with finances in general, it's wise to as a general rule, not put all of your eggs in one basket. And I think that kind of is a callback to what you were talking about with diversification, things like that. But yeah, never just throw it all into one thing, I think is what I'm hearing.
Yeah, absolutely. Spread it out.
Awesome. And then the final strategy you have here for us is to maintain a long-term perspective. What does that look like?
Yeah, really, it is about not panicking. And that's easy to say, difficult to do. But especially if you're reading the news all the time, I personally haven't checked my 401k this year. I don't plan to because it's scary. It's scary to look and see what the market's doing every day because it's a roller coaster. But keep in mind, markets they rise and they fall. So over the long term, the stock market is probably going to work out for you if you've maintained diversification in your portfolio. But general rate of return 9% or so. But when you look at it in small chunks, yeah, you're going to have years where it's down 10%, even 20%, and you're going to have years where it's up that as well. So keep in mind, history, it favors long-term growth. If you've got time on your side, it's going to work for you. So if you have a balanced, diversified portfolio, just remember the markets are going to go up and down, but over the long term, it's going to work out for you. And don't panic there. When you react emotionally to those sorts of things, it can lead to bad financial decisions. We've talked about that on other episodes before as well. Try to set emotions aside and just think logically and rationally about, is this a good investment? Do I know either, if you're investing in a stock in a company, do you support that company? Or if you're putting your money into a bank or a financial institution, do you feel like you understand that bank and its values? And does it align with yours? So try to take some emotion out of the equation and just think logically about, is this a safe and secure way to grow my money so that I can earn a rate of return that hopefully surpasses or at least meets what inflation is doing? And then stick to your strategy. So here at OMB Bank, we're big into strengths finders and the Gallup strengths and what those mean. Pretty high on my list is strategic. I'm a naturally strategic person. So when I find a strategy that works, I tend to go with it and stick with it and just ride it through to victory. So obviously, when you find a strategy that seems to be working for you, stick with it, because that's important, I think, in writing out the ebbs and flows of inflation, is to find that strategy and to go with it. And then look at educational resources. So the best thing you can do for yourself, especially when it comes to inflation and these big macroeconomic concepts, is to just educate yourself. Just read more on blogs about what investing looks like, or other ways, other ideas that people have come up with to combat inflation. Just generally be inquisitive and use financial literacy as a tool to help better yourself and your knowledge in what it is that you're doing with your money for yourself, your family, things like that.
Yeah, and patience, I feel like, is just so crucial in so many different areas of our financial health and wellness. I mean, whether you are trying to build up a savings, you're trying to pay off debt, whatever that looks like, I think patience definitely is key. And I think that can certainly be applied here as well, as you are writing out different economic conditions and bracing yourself for inflation, things like that. So I think that that's certainly excellent advice. Well, and as you mentioned, of course, you and I both work at OMB Bank, headquartered here in Springfield, Missouri. So do we at OMB have any accounts or services or different things that might be eye-catching to people that are worried about inflation or that want to have safeguards for their assets?
Yeah, absolutely. So here at OMB, we've got some core products: a 2.01% APY high yield checking account that is our most popular checking account. So if you're looking for something as a primary checking to pay bills out of, do direct deposit into if it's like your paychecks. Can't recommend that one enough. Over time, we have never changed that APY. So in a lot of things, you see why people maybe don't necessarily go with the banks is they're afraid that the rates are going to change. We've not changed that one. We've stuck that one out, and I think it works pretty well. We also have a 1% high yield savings account you can tie to that. So you can get over 3% between the two. So highly recommend going with those products. Obviously, we have CD specials out there all the time. Our rates right now are over 3 and 4% for some fairly short terms. So you could do, as low as 7, as high as 27 month, and still get a really great return on some CD specials we have going on right now. Of course, those specials are usually for a limited time, but generally speaking, we've always got one out there. So highly recommend those products, especially if you're looking at some sort of CD staggering structure. I think it's really going to work to your advantage to use some of the high CD rates that are out there right now.
Awesome. Yeah, I think we have lots of solutions, and it does sometimes seem like people tend to shy away from banks a little bit or feel a little level of mistrust when the economy is in a tough spot, and that's completely understandable. But just know that like we have solutions as well. So great. Well, if you could leave our listeners today with just one final piece of advice regarding economic turbulence, inflation, what would it be?
I would say it's, start small. Just review the financial situation that you're in. Look at what you're spending your money on, how much money you're bringing in, and then what you can do to start to move some of that money into safe interest earning accounts. So I would start with guaranteed returns. I think those are your safest bet. And if you're, scared of, say, the bond market, or I know people hear a lot about that, and they're like, generally they think it's pretty safe, but obviously there's a lot of nuance to that. But going with a local community bank that's got a high rate of return on a savings account, a CD, even your checking account, because those institutions are insured by the FDIC, they're protected, and you're guaranteed those returns. Even if there ever was a run on the bank, your money is still safe and protected in those cases. So first thing, start small. Second thing, start to move money, especially cash that you have, into high interest bearing accounts. And over time, those things are going to help you combat inflation as prices go up.
Fantastic. Well, I think you gave us all some really actionable things we can do to chill out a little bit. And so that's great. Thank you, Ryan, so much for joining us today. We appreciate having you.
All right. It is great to talk to you again, Madison. Please join us next time on the Money and More podcast. Hope you have an awesome day.
The Money and More podcast is owned by OMB Bank. OMB and its affiliates do not provide legal, tax, or accounting advice. You should consult your legal and/or tax advisors before making any financial decisions.